Rose, Longwood currency trading. I've been working all morning on stuff and looking at charts, and it dawned on me that I should probably do a video to post. And so before I do that, I came in here to get coffee, as you can see. And so we're going to take the coffee in, get some cream in it, and figure out what we're going to do. So catch you in the kitchen. Coffee is ready. Yeah. Yep. So the video topic is, when do you close your Forex position? When do you close it down? Obviously, one of the times you close it down is when it hits your stop loss on entry. Let's call it entry stop loss. And I've done videos on that before, and so I'm not gonna beat that to death. But before I get into the rest of the video, I'm gonna take you into the library where I think I'm gonna do this video. My leg is sore. I was up helping Sue wash the windows for the fall washing and getting the storm windows down. It was down to 48 degrees last night, and so we need to start battening down the hatches for the winter up here in New England, because it'll come on quick. So anyway, leg is sore. Going to go in and sit in the library and do this video for you. Now, an interesting aside for you before I get in there is I did a comment. I did a video not long ago on how not to get subscribers to your video channel or whatever, and talked about my rather casual style and using a GoPro camera and all that other stuff. Well, I had a comment the other day from somebody who says, gee, you're not like everybody else. You've got a fairly cluttered background behind you all the time when you're doing these videos, where if you look at some of the more refined video producers, they have these pristine white backgrounds with a couple of plants and some books on the shelf. Let me tell you, I got so many books I fill up the whole room, and I don't really care. It's a relaxing area. The library is a relaxing area for me, as is my whole house. It's a 1775 antique cape, and I love sharing it with you all. And I get a lot of comments about how nice it is, and thank me for doing like a day in the life of walking around my house and around the land that I've got, 2.7 acres. But they said, we kind of like to see what the library is all about. What do you got in there? So let's go back and see that, and then we'll do this video. And I'm sorry if you don't like these kinds of videos, skip ahead. Okay, let me get my coffee, and then we'll take a hike in there, and we'll see you in a minute or so. All right, so here's the library. As you can see, there's an awful lot of books in here, and that's the way that I like it. We'll go up here. This top shelf is all literature. As you can see, Jane Austen. Actually, the top two shelves are literature. The gargoyles come from my mom's estate. She really liked them and had them on her bookcase. The next bookshelf down, there is an elephant bell in the back that you can see that my mom got when she was in India visiting on vacation. I've got my slide rule from when I was chemistry major in college, and also my physics. The next group of books all have to do with writing, because I've written probably about a dozen, 20 books, something like that. Nothing published, I just like writing. And then down below is another section of books written. Below that goes into history and Western civilization on the two bottom shelves. Over there in the corner is books on chess and books on backgammon. Books over in this shelf, the top shelf over there, that's all karate, because I've been in martial arts for 50 years. The books down below that are all sailing. I grew up sailing a small boat with my dad, 12.5-foot sailboat on Lake Michigan. All of these books over here on the right are computer and mathematics, programming, and those types of books, mostly programming. And the shelf down below that, the 3 books in the series, the Feynman lectures on physics. If you're interested in physics at all, those are the books to get to read, because that's the absolute nuts. And all the other books are books that I had from my physics and it's all physics in college. It's my work area. The ship model up there, I built that when I was 14 years old. My dad had bought that exact looking type of boat, and I grew up with that in our study, and so his boat was probably 10 years old, 20 years old at the time that I built my replica of it, and that's an exact replica of that boat. And I built that when I was 14. I'm 72 now, so that's holding together pretty good. Over here, all the books on the top shelf up there have to do with mostly philosophy and thought process, and even Robert Ringer's book, Looking Out for Number One. There's a lot to be said for that. Down below, Market Wizards and Why Stocks Go Up and Down, Security Analysis, books of that genre, as well as the second list down, section down there. These books are Native American. I've studied Native American history quite a bit. Down below, just general business type oriented books for your head. And as you all know, you've probably seen these books before. These are all commodities and trading books, and the below books from that are a subset of all the currency trading books that I have. The bottom 2 shelves are all currency trading books stacked up on top of each other. And so there's the computer area and my current book and stuff like that. So, sorry to swing you around like that, but, you know, look, this is where I work. This is what I feel comfortable in, and I enjoy sharing it with you. So hopefully you enjoyed my little tour. Now let's get down to some business. Okay, let's get on with it. When do you close your Forex positions? They said in the kitchen, the obvious entry stop loss point is, that isn't even worth talking about, because, well, I mean, it is, because there are some very specific things that you need to consider. Entry analysis as the first phase of the life cycle of a currency position is a very complicated phase, and there's a lot of moving parts for that. And I've talked ad nauseum about that sort of stuff. But just to keep things simple, you have a stop loss point, and entry doesn't go in your favor, boom, and you're gone. You're out. You're not even in the decision process. Hopefully, you're not. So when do you have a different exit decision to make? Well, when you leave your entry analysis phase of the life cycle of a currency position and you move into position management, that's when you're going to stumble into certain things that will occur that will cause you to exit your position. Now, that bleeds over very closely into the exit methodology phase of the life cycle. If you're doing long-term trading, then position management is encompassed within its stuff, and exit methodology is a whole other issue. When you're doing short-term trading, the two tend to bleed together and can also be merged, because what you're doing in position management is getting yourself ready to close the trade. And so we look at that. We look at that particular position. We look at that from a short-term trading standpoint, because the signals that you get and use are different in magnitude than they would be if you were doing it on a long-term position. You do the same thing, but you're not going to get the same recognition out of the process by doing it long-term. You really need to do it, bing, bang, boom, down on the shorter-term time frames before you finally get the theory. In any event, you've got a position that's in profit. It's a running position in profit, and you're in the position management phase of the life cycle. So the first closing issue that you have is when the price reaches the profit target. Yeah, I mean, you get out. Now you go into all kinds of staging out positions and letting the thing run and all that other kind of stuff. But we're talking about just simple bare bones theory. And then when you get more experience, or if you are more experienced, then you can do your staging and let them run and do reverse ads and all that other kind of crap that you can do to it. We're just talking about the simple mechanics of a decision process of when to close that trade. You got a profit target there. When it gets there, boom, you're out, you're gone. If you don't close it at the profit target, you're going to take some meat off the table, and then you're going to let that run, but you're going to let it run as a new entry position. So now you're evaluating it almost as a new entry. So the things change dramatically. So we just want to say, if it hits your profit target, boom, you're out, you're gone. So the only other time that you're faced with an exit decision then is something happens while that price is running and it's in profit to change your mind that you should get out. Again, we're going to make this very, very, very simple, because there's all kinds of shadings to that picture, right? That you could get into in deciding whether that position should be exited or not. But let's make this easy. I'm going to define that easy thing as when you see that price starts to chatter on the shorter time frame. It's called chatter. If you're up on the longer time frame, then the price would stagger. Staggering means that it's bouncing back and forth in a channel that's long-term wise would be staggering, 15, 20 pips, going in a 15, 20 pip wide channel. Maybe a little bit more if you're trading up on the daily or a chart monthly. You may give it 30 pips to chatter. I don't know. Richard Dennis and his turtles, they give it 4R. So you do whatever you want to do. But down on the shorter time frames, we call it chattering, because for me, in trading on a 5-minute time frame with a candle that has a 5-period ATR, I'm going to be looking down on a 5-second time frame for chatter. And that chatter is going to go back and forth 1 or 2 or 3 pips. And I'm going to look at that chattering situation for about a minute. If it doesn't do anything, I don't know whether that's a good sign or a bad sign. So I would probably exit, because it's not doing what I thought it should do. If it continues to go up, it's not an exit event. I might adjust my running stop to bring it into that chatter area so that I'm not sitting there wringing my hands about it. But if, after chattering back and forth between that 1 or 2 pip boundary, because 5-second has a half a pip ATR, right? So that chattering over a 1-minute period, let's say, you've got 5 1-minute periods in there, so you're only 20% through that a 5-minute candle. It started to bend down. Where do you think you would see the 5-minute, on the 5-minute chart, a change in that candle direction? You'd see it after maybe 10 minutes. Well, if I'm looking at the 5-second chart and judging that in 1 or 2 pip or time frame range, I mean, that's 2 pips with a half a pip ATR there on those 5-second candles. 2 pips, 1 or 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 2 pips, 1 whatever's happening down on that 5-second chart will ultimately be manifest up on the 5-minute chart. You know, the 5-minute chart doesn't just go up 5 ATR or 5 pips or whatever. It doesn't need to go up 5 pips. It goes up a half a pip per 5-second period. And you string a whole bunch of those together and you end up with, magically, with a 5 pip bar movement. So whatever you see going on down on that 5-second chart, even though there's a lot of noise down there, that's fractal. You couldn't tell the difference between movement on a 5-second chart and a daily chart if you took the time frame off and you took the scale off. You couldn't tell the difference because it's fractal. And so you do need to pay attention to those shorter time frames. I mean, if you're up on the daily chart, your chatter might be on the 5-minute chart, or it might be on the 15-minute chart. You know, that's up to you. But if you're trading down on the 5-minute, then you're probably going to be looking at that 5-second chart. Remember, that's only 2 logical periods, maybe 3 below the 5 minutes. You go 5-minute, 1 minute, 30-second, 5-second, and I don't even bother with 30-second. It's 5-minute, 1 minute, 5 seconds for me. So when you see that price start to chatter between a 1 pip or a 2 pip boundary line like this, and then it starts to arc down on you, and it goes down to about a pip, you're not even going to see that in the candle yet. It's just like a normal move. But on a 5-second chart, it's magnified. And so if that happens, that would signal to me anyway, and don't do what I do, I'm just telling you what I do. I'm not suggesting that you do what I do, because I have different experience than you do. I'd have to work with you personally to understand where you're at and what you're doing in order for me to give you really valid advice as to what I think you ought to do. I'm just doing videos. This is for entertainment. And I'm entertaining you here with a story that if I see the 5-second price start to chatter and it moves 2 pips against me on that 5-second period, I'm going to start thinking about closing that trade. So what I have is a rule. Remember, you go back to your rules. You have phases in your analysis that you do. The full life cycle framework of a position is entry analysis, position management, and exit methodology. So right now we're in the exit methodology phase of the life cycle of a position in that framework. And the rule there says this is an exit event. What is the rule that would cause me to exit a running profitable position? If the price does this, whatever you determine that should be, then I'm out. I'm not out a little bit. I'm not thinking about it. I am out, period. And that's it. That's my rule. It's a simple rule, and it gets me out of the shit. If I get out and the thing turns around and goes back up, because there is a lot of noise on that 5-second time frame, I could always get back in. But if I choose to get back in, I must create a brand new entry analysis phase. I got to go back to square one and do entry analysis. I can't just get back in that trade because, oh, it was going successfully in the direction that I thought it was going to go in. Oh, it staggered a little bit, but now it's continuing on the way. No. That's not a good enough reason to get back in. You can't do that. That has to be treated as a whole new entry analysis phase process. If it chatters and it starts to go against me and it gets to the point where I've predetermined in my rule, if this happens, if it goes two pips against me, for example, I'm out. I'm not out part of the way. I'm not thinking about being out. I'm out. So when do you close your FOREX position? You have basically four options throughout the full life cycle of a position in order to make a decision. Better yet, that you make a rule which makes the decision for you. And that rule is based on one, maybe two questions that you might ask yourself. So at most, the full life cycle, you're going to have 8 rules in order to dictate and run for your whole trading. Now, I say that with a caveat because there are 2 different kinds of movement that you need to consider. One is if price is a trend, and another one is if price is in a chop. Now, a chop is just a horizontal trend, okay? However, there are radical differences in the mathematics of wave construction between a chattering wave and a trending wave. And you need to understand those characteristic differences because the rules that you build for each one of those scenarios are different. And that makes a trading just not twice as hard, but you do have to take that into consideration because price action is different when it's trending than it is when it's in a chop or in a horizontal band or a horizontal zone that it's trading in. And you know, particularly on the shorter term time frame, well, it doesn't matter. It's fractal. It doesn't make any difference. But trends, you know, a really good trend is only about, oh, I don't know, 20 to 30% of the full cyclical range of of price action within a cycle. And so you that's why you have these specific scenarios that you need to develop in a trending environment that is not applicable perhaps as much in a chop environment. You can take a trend and break it into levels that are bordered by support and resistance, but you have to be somewhat cautious in that because support and resistance zones are subjective, they're not objective. And they are fraught with the issues of the larger institutional traders who are creating those support and resistance zones. The retail traders are only 50. We're only 15% of the market. We're not creating support and resistance. We may be the dead fodder that suffers as a result of those zones, but we're not the ones that are creating them. The larger institutional traders are. And then you have to take a step from that. Well, why are the institutional traders doing it that way? It's because their customers are ordering them to say, I need $2 billion worth of X currency in exchange for Y currency so that I can buy auto parts over there. And so there's an economic force that's involved. And so the longer the term of the time frame that you're trading on, the more of the economic consequences you have to take into consideration for all of the rules that you're developing. That's why trading down on the shorter time frames is so easy, because you don't have to worry about any of that shit. You're in and out by the end of the day. I don't like to trade for more than a couple hours a day. If I can't make 5 or 10 pips in a couple of hours, I'll have a cup of coffee and not trade for that day, because there's no trade event possible. I just want to get 5 or 10 or 15 pips and call it a day. I'm down on a 5-minute chart. Come on, that's 3 bars. I just got to get the 3 bars going up in the right direction. I can do that in a couple of hours. Now, the 5-minute chart, I got 12 trade decisions an hour to make. Somewhere in a 2-hour period of time, I'm going to find a trade. Peter Rose, Longwood Currency Trading. Have a great day and have a great trading day.